All right, guys, hello and welcome to this special video with our good friend Manue Blay at dowtheory.com. In this video, I want to talk about this fascinating and shocking chart and what it potentially means. All right, guys, so join us. All right, guys, welcome back. So, Manuel, how are you doing, by the way? You're in the Dominican Republic. Very lucky. First of all, how's the weather for you over there in the Dominican Republic?
It's great, and it's not so hot as in Europe. So really great time right now. And you really have a knack for making great videos. No, really. I love when you are in Iran, and it's really unbelievable.
Oh, I see. Thanks for the invitation. Thanks for the invitation. Just so everyone know, Manuel invited me to the Dominican Republic. I'm considering it. We'll see what happens for next year. We'll see what happens for next year.
Mountain, really. We have two great settings on the beach and on the mountain. Really,
beach and mountain. That should be good. That should be. I look forward to it. I look forward to it. By the way, for those of you who don't know, the dowtheory.com newsletter has been considered by the Wall Street Journal to be one of the top 5 best market timers in the world. For those of you not familiar with Dow Theory and the dowtheory.com newsletter. Okay, I'm going to bring in Manuel, and I apologize for keeping you just a little bit waiting there, Manuel, because I'm going to cover some important points. Last year, as you may recall, I put out a video talking about inflation and bonds. And last year in my video about inflation, I said, first of all, that I thought inflation was going to continue going higher. So I was not saying that inflation was going to end last year, as you may recall. So I said that likely inflation could continue at least for another 6 to 12 months or 12 to 18 months, maybe even for the next few years, before finally we see a drop. In fact, I'll put a clip for you guys to have a look for yourself.
Again, we have to remember, guys, that the economy is lagging behind the market. When I said in my previous video that deflation is going to win, I wasn't saying deflation is going to win right now. That is what the smart money is anticipating by its actions, and that means deflation is something we're likely to see in the next few years, not immediately right now. So right now we're seeing inflation winning. What's happening in the market only takes effect about 6 to 12 months later.
But in any case, I was wrong about one thing. So even though I expected inflation to continue for the next few years, the bottom line is that I was wrong about the extent and the pace of inflation. So it went a lot faster and a lot higher than I thought it was going to. Okay. In fact, it went as far as 8.6 and 9.1. So while I was wrong about the extent and the pace of this inflation, however, I want to make a very important point here in this video. Actually, I have a very important call I want to make about inflation, which I think we're reaching a point now where we could see a drop in inflation. Now, I know what you're probably thinking, no way, that's not going to happen. We're not going to see a drop in inflation. Okay, let me just make it clear. I'm not saying it's going to happen immediately, but I think by the end of this year, but likely by the next 6 to 12 months, perhaps even sooner, I think we're reaching a point where we could see a drop in inflation or a disinflationary period. Let me explain my point. In case you think I'm mad or crazy, I'll explain to you that there is some method to my madness, in the words of Hercule Poirot. So firstly, why? We've had a second quarter of GDP negative growth, 2 negative quarters of GDP, which is a strong sign of a recession. So if a recession is likely, which seems to be likely based on the GDP figures, then recessions are correlated with deflationary or disinflationary periods. Look back at 2008, look back at 2000. I can see Manue Blay is nodding his head. He agrees with me on this point. But we'll bring in Manuel in a few minutes. A recession tends to be a period of economic deceleration, and that's usually disinflationary or deflationary. So that could be a sign that we could be heading towards a drop in inflation or a reversion to the mean. Second point is this: we've seen oil prices break key levels. It's likely oil prices could drop in the next several months. That could be also a sign of deflation or disinflationary period, or a drop in inflation anyway. We'll see about that. The next point, the key point, is this: bonds. Bonds, as I'm sure you're aware, the bond market is the market that knows everything. So bonds are likely carving in a bottom, in my view. It looks like we've got a head and shoulders bottom on bonds or TLT. We've broken some key levels. So if bonds are likely to bottom and go higher, that's a sign that institutions or the smart money is betting behind the scenes that likely we could see a drop in inflation, because when bonds go up, it's a sign that the smart money is betting that in the next 6 to 12 months, we could see a drop in inflation. Remember, the market always moves at least 6 to 12 months before the actual economy does. The economy is lagging, the market's moving ahead. It's a leading indicator. So if bonds continue to push higher, if bonds are bottomed for now, it's a sign we could see a likely drop in inflation or reversion to the mean in inflation. Perhaps not immediately, but perhaps by the end of this year, perhaps in the next 6 months, or perhaps in the next 6 to 12 months. By the way, in case you're thinking, no, because what about the 70s, the 1970s, we had a major inflationary period, and you might think, well, we're in a similar 1970s inflationary period. Because as you may remember, in the video interview I did with Lynn Alden, the economist, I talked to Lynn Alden, fantastic analyst and economist, she said this.
So generally, even in inflationary periods, usually economic contractions are disinflationary, but compared to the inflation that you're already in. So for example, in the 1970s, even though that was a very inflationary decade, you had more inflationary and less inflationary periods. And that was partly because there were periods where central banks would try to fight back. There were periods we had economic contractions, and those were generally the more disinflationary periods. But that could mean, for example, you go in the 70s, you'd go from say 8% inflation down to 4% inflation. It was still an inflationary environment, just less so.
Even in the 1970s, in 1974, I think it was 1975, 1974, we had a drop in inflation. Inflation actually dropped by 50%, which was also a recessionary period as well. So that's something to bear in mind as well. Manuel, what do you think about this? Am I crazy? Have I lost my mind? Am I mad? What do you think?
No, you are not crazy at all. I feel it's really very similar to the 70s. I know, well, now maybe it's even worse because we have higher debt, but there is a supply issue, and this is a similarity I see with the 70s. So in the 70s, there was the oil crisis, so there was a problem with commodities. And now I think we are having a repeat of the supply issues. First, we had the coronavirus, which also disrupted supply chains. Now, it saddens me to say, but we have war, and war is also affecting supply chains. And furthermore, the green transition, which is also costly. So I don't make any political statement here, but what I see is that supply is constrained. When you have a supply issue, we get this scenario you have just described. So when the economy starts to go up, then immediately because of supply issues, we get inflation because there is not enough supply to meet demand. And then, of course, then the economy cools off, and then, of course, inflation goes down, and in the very moment we get a recovery, inflation goes up because supply does not meet demand. So I agree with you.
So what about the bond? Let's talk about the bond market now, because that's the most important market right now, because, again, a rising bond market is a sign that the smart money, the institutions, are probably betting in favor of seeing a disinflationary period over the next 6 to 12 months. Again, we're not saying inflation is going to peak immediately, like straight away. This could continue to go a bit higher, but I think a drop in inflation or reversion to the mean inflation is likely, as Manuel also was talking about. I want to talk about TLT, the 20-year treasuries, and IEF. In your most recent newsletter, Manuel, you mentioned that if these two markets, TLT, 20-year treasuries, and IEF, the 7 to 10-year treasuries, if they break above a certain resistance level, which I think was the highs of, I forget which month, was June or July. If they break above those levels, then likely we could see the start of a bull market in bonds, or at least a bullish reversal or an uptrend, potentially in bonds.
It is the start of a bull market, and I'm looking at my chart. We got such breakup on July 22nd. So from a Dow theory perspective, we are in a bull market. I would like to say that the Dow theory works especially well with interest rates. So it is really a great market. So normally we get very accurate signals. So the trend, the primary trend is bullish. Anything can happen, it's probabilities. But on July 22nd, we got a confirmed breakup by both IEF and TLT. So the primary trend is bullish right now.
So two things to mention about this. We got a bullish divergence on the MACD. We made a lower low recently in the last few months, but a higher low on the MACD. That's a very bullish sign for bonds. Plus, we broke the key levels of resistance that Manuel was talking about as well with IEF, the secondary market as well. Confirmation based on the Dow theory. I think as long as TLT, as long as bonds, 20-year treasuries can remain above support, about 110, 112, I think bulls are in control. And a likely bull market is in place, provided we remain above $110. Below 110, if it falls below that, I think the odds would be reduced, and we could see another drop to lower lows, and that could be a bad sign for inflation. If TLT breaks that support at 110, it might mean we may see more inflation going through the next 6 to 12 months. but that's only if those levels break. For now, as long as we remain above those levels, 110, 112, I remain bullish on bonds, and I think we could see further uptrend continue. By the way, guys, before we finish, let me mention that I highly suggest and highly recommend check out the Dow Theories newsletter. Manue Blay is the editor of the Dow Theory. Check out this link, which gives you 1 year's access with a 25% discount. We gave this last year, but Manuel and Jack Shannon have given it again. So 25% discount on their newsletter on that link, thedowtheory.com/LT. Do check it out. Definitely worth it. So thank you very much, Manuel. Thank you, Jack, as well.